Thanks for watching this brief investment video. I'm Ross Bramwell, a member of HB Wealth's investment team. Last month, we discussed how the recent inflation data would impact the Fed's meeting last week, where the Fed decided to ultimately resume its rate cutting cycle. We also discussed how earnings have continued to beat expectations as the U.S. consumer it remains resilient and companies have been able to largely mitigate any tariff impacts. In this video, we'll discuss the Fed's other mandate, employment, and why a softer labor market has allowed the Fed to cut rates despite data indicating an otherwise growing economy. We'll also discuss whether we believe the job market can hold up until additional fiscal stimulus is delivered to consumers in early 2026, which may be the key to avoiding a recession. Last month, we had the largest preliminary job revision ever to a 12-month period. This was for the 12-month period ended March 2025, where the revision was almost a million jobs, which raised concerns that the job market is weaker than even current jobs data indicated. This gave the Fed latitude to resume its rate cutting cycle last week, even though goods inflation has risen and services inflation remains sticky. It is important to remember that the revisions impacted a period as much as 18 months ago. In looking at the chart, the positive point I'll also want to make is that when the large revisions or after the large revisions had often peaked, there was a period of economic expansion. And this was seen after 2000, 2008, and 2020 recessions. So after we normally had peak revisions, we saw the expansion periods. And we've seen this after prior economic weakness. And so here we'd be looking for something similar that could potentially occur within the next 12 months. Investors believe the weaker jobs data will lead to multiple interest rate cuts before year end. However, as markets have hit new highs, investors believe recession risk has not materially increased. One reason may be that when taking a closer look at jobs data, the preliminary benchmark revisions tend to improve over time, as we see here on the chart on the left. Going from the preliminary estimates to the final estimates, they have improved each of the last 5 instances. And also, when looking at August jobs data in particular, since the pandemic, it has also tended to improve over time. Here we can see that for some reason there's just some seasonality in August. From when we have the first to the final revision, it has continued to see better data. Although jobs data is softening, it remains fairly balanced given the decline in immigration, which has supported consumer spending. It's important to remember that initial reports are timely, but they are not always accurate. This historical data helps investors look through some of the worst concerns about employment right now. I just want to make a couple of points on this chart. First, we did see a jump in initial claims 2 weeks ago, here on the bottom left. But then we saw the initial claims number settle back down into a range that we have seen for most of the summer. We'll be watching this closely to see if it was a one-off or if it's the start of a trend higher. Overall, as the monthly changes in employment up here in the upper right-hand chart continues to decline as we watch the 3-month rolling average, it's important to note that we are in a hiring freeze, but also a firing freeze. The phrase job hopping has turned into job hugging. It has stalled on both sides. This has led to the fairly balanced jobs market that we have today. The key to remember is employed consumers spend, right? And that narrative remains intact as of now. We'll continue to watch the continuing unemployment claims here on the bottom right, but for now, it seems to have stalled out in a fairly tight range. Although we have seen some softer jobs data in recent months, it is important to put it in context. In the current context, we believe it is important to remember 2 other variables which certainly impact employment. First, current immigration policies have created a drastically different dynamic for the employment growth. As immigration has collapsed nationwide, it is reasonable to expect that the break even to keep unemployment at a current level would be lower. Second, we have seen historically high unemployment rates for college graduates this year, in part due to the adoption of AI and how that is changing entry-level jobs. Right now, as shown in the chart, the overall employment picture remains fairly balanced, here showing that the number of unemployed persons is roughly equal to the job openings. Given that the labor market is weakening, it gave the Fed room to cut 0.25% at its recent meeting. The Fed is still holding its key rate above most inflation metrics. We believe it is likely that the Fed will make additional cuts before year end if recent jobs data persist. Whether the Fed is able to make Additional cuts in 2026 may be a tougher decision if economic data continues to impress or if there's any delayed inflation impact from tariffs that shows up in the data in coming months. The fact that the Fed cut and longer term rates actually rose is an indication that it's not a done deal that the Fed will be able to make additional cuts before year end. A key to avoiding a recession will be whether the labor market can hold up until the fiscal stimulus from this year's tax bill passage begins to impact the economy. Companies will begin to realize some impact this year in 2025, but consumers may not see the largest benefit until early 2026 when tax refunds are processed in Q1 and through the spring. As consumers' spending surprised in the most recent report just last week, this could be the next tailwind for consumers as long as employment holds up until then. In addition to consumer spending stimulus that's expected by the passing of the tax bill, just plain old and reliable government spending continues to occur at historic levels and is also a tailwind for economic growth in the short term. Now, the flip side is at some point the bond market could decide that there is too much debt and long-term interest rates rise. But so far this summer, bond yields are not indicating that current levels of debt are a concern. So the fiscal spending has supported the stock market's rally to all-time highs. With continued fiscal stimulus by debt spending and the passage of the tax bill this summer, it has led to a rebound in U.S. GDP in Q2, which was 3.3%. And also the Atlanta Fed Now GDP tracker is also estimating Q3 GDP at 3.3%. If that growth level can be maintained through year end, it should allow companies to sustain employment levels until the additional stimulus arrives next year. Since 1990, there have been 9 instances where the Federal Reserve has cut rates while the S&P 500 was at or within 1% of an all-time high. While forward returns have been mixed depending on their broader economic backdrop, they have typically been positive. After a year, the median return has been roughly equal for cuts at all-time highs and cuts at any point in time versus a period. Here we see this on the right-hand side, 8% when at or near all-time highs and 9% for all events. We believe that the bar for U.S. stocks to continue delivering strong returns is high, but Fed easing and still resilient economic conditions may support valuations and earnings growth in the near term, allowing the rally to continue. Thanks again for watching this video. If you have any further questions, please reach out to a member of your advisory team.